Okay, I want to welcome everyone to our webinar today. We appreciate everyone being here. We want to thank you for coming. It's about the travel rule, what crypto companies need to know. We're expecting to run this webinar for about 1 hour, and we're looking forward to having everyone participate. A couple of quick things that we want to touch on before we get started. One of them is the issue of questions. We very, very much welcome your questions. If you take a look down at the bottom of your screen, there is a Q&A button, and that's the place to give us your questions. So just click on that button, type in your question. We'll try to answer as many of them as we can over the course of the webinar. And we're trying to save them for the end, generally speaking, because a lot of questions get answered over the course of this webinar. So bear with us. We'll try to get to as many of them as we possibly can. So with that, I'd like to go ahead and tell everybody who is on our panel, because we have a very great panel today and we're excited to have everyone join. So let me introduce the members of our panel. We'll start with first Joe Cutler. Joe is a partner at Perkins Coie law firm, where he helps clients navigate the complexity of surrounding token sales, digital and self-sovereign identity, IoT, AI, and blockchain. He's a co-founding member of the firm's fintech and blockchain technology and digital currency industry groups, and he's extensive experience working with legislatures both at the state and federal level. Joe, thanks for being here.
Thank you.
Our second panelist is Tiana Laurence. She is currently the managing partner for Laurence Ventures. She has so far founded 5 businesses, her first at age 16, including the enterprise software company Factum. She's also an author. She wrote the Amazon bestseller Blockchain for Dummies and is a frequent contributor to publications including TechTarget and Forbes. Tiana, nice to have you here.
Thanks for having me, guys.
We're also delighted to have Colleen Sullivan on the panel today. Colleen is the Chief Executive Officer of CMT Digital Holdings and has been a partner with broader CMT Group for 5 years. As CEO, she oversees their trading, investments, and regulatory initiatives in the crypto assets, blockchain technology space. She is also the co-founder and managing member of the boutique law firm Sullivan Wolf Kalis. Colleen, great to have you here.
Thanks for having me.
And Justin Newton rounds out our panel. Justin is the CEO and co-founder of Netki, the leader in digital ID validation solutions for onboarding, KYC, AML, and travel rule compliance. He has previously helped guide 4 startups to successful IPOs valued at over $1 billion. And Justin currently serves on working groups in the Blockchain Alliance, as well as the Chamber of Digital Commerce. He is also one of a handful of people that have contributed to authoring both internet standards and Bitcoin standards. Justin, always great to talk with you.
Thanks for having me here today, Tom.
All right, so we're going to start with Joe, and let's get into this question about the travel rule, Joe. We want you to take us through. Tell us a little bit about what is the travel rule, what does it apply to, and what do companies need to know about this?
Well, thank you, Tom. And I think the first thing we'll do is just give you a really quick roadmap of where we want to go. Over the course of the next 10 minutes or so, I'll be sort of describing the travel rule, who it applies to and what are the exceptions, talking about the specific obligations and maybe the steps that might happen if a regulator contacts you. And then I'll get into a little bit of interesting legal wrinkle that has come up lately. So when we talk about the travel rule, if you ask yourself, what is the travel rule? I think that, you know, in the United States, we think of the travel rule as an anti-money laundering law. And it's a rule that exists under the jurisdiction of the US Treasury. And it is a rule that governs the movement of funds between financial institutions. And the purpose of the rule is to prevent money laundering, to track transactions, to make sure that money doesn't vanish in the process of being laundered, to counter terrorism, and to improve traceability. The FATF rule is similarly situated, and you know, the way that FATF works is that it's a recommendation body that gets together among many different countries, sort of contribute to it. And this latest effort with the travel rule has been to try to consolidate and harmonize what's expected across jurisdictions. As money moves around borders, it's just a lot more commonly subject to various rules, and can get confusing, you know, when you have to comply and when you don't. So FATF also has a travel rule. The U.S. rule is adopted as a harmonization with that recommendation. As you can see here on the slide, FinCEN's first version of this was in 1996, and the FATF rule and the U.S. rule are not exactly the same. And as you can see here, the FATF rule applies in similar way to the U.S. rule, but it really focuses on wire transfers, whereas the U.S. rule focuses on just inter-institutional transfers. And we'll talk in a second about how FATF is expanding itself to recommend more than just wire transfer regulation. The basics of the rule are that you have to first be above a certain threshold in order to have to follow the rule. Small transactions are not subject to it, but if your transaction is in the United States over $3,000, or if someone's following the recommended FATF rule, it starts at 1,000 pounds. Every country can choose, when they adopt the rule and implement it in their local regulations through law, what threshold they want to choose. This drop from 3,000 to 1,000 was very recent. It was this summer. Prior to this summer, the $3,000 rule and its equivalent were a lot more harmonized. And I think it's really important. There's been a lot of conversation about the travel rule and a lot of hype and hoopla about how it might cripple industries like the crypto industry. And one of the misunderstood things about both the U.S. travel rule and the FATF's recommended rule is that it isn't meant to apply to peer-to-peer transfers. It's not meant to apply to financial institution to non-financial institution transfers. The rule essentially says, and here's sort of the synopsis of the rule, you have to collect, if you're a financial institution and you're custodying funds or digital assets of someone else, like a customer, if that customer asks you on their behalf to transfer those funds somewhere, you have to follow the travel rule if that somewhere is another financial institution. So a simple example would be, if I have Bitcoin in an exchange and I log into my exchange and I say I want to transfer my assets from Coinbase to Gemini, that would be a financial institution to financial institution transfer. The travel rule would apply, and the sending institution would be required to collect and store and keep records on certain information related to that transaction, including the name and information of the receiving institution. An interesting ripple at the bottom here is that while the U.S. travel rule focuses on virtual currency, and more specifically convertible virtual currency, which is a term of art that FinCEN has adopted with respect to its virtual currency guidance since 2013. The FATF rule is more expanded. It applies to virtual assets, which arguably could include some either pseudo or even non-financial instruments. And I think that's probably not intended, but their definition is not tight enough to prevent that application. And so it'll be interesting to see whether jurisdictions that want to be expansive in their adoption of this recommendation keep that broader aspect of virtual assets, or whether they limit it like the US did to virtual currency. So there are some exceptions. The FATF rule is not meant to apply if the transfer from one institution to another is for the purchase of goods or services from credit, debit, or prepaid card usage. It's not necessarily intended to apply where you're moving your own assets to another institution for yourself. So for example, the example I gave before of moving my assets from my Coinbase account to my Gemini account, when the originator and the beneficiary are myself, and I'm acting on my own behalf, then it's not necessarily true that the FATF rule will always apply. And it's a little bit convoluted, because you'll see here the language in purple. The language says where both the originator and the beneficiary are financial institutions acting on their own behalf. Now, there's been some debate over what they mean, whether they mean the institution moving its own funds or the institution moving the funds of its customers. The people who are more conservative say that it is really meant to include only the situations, the exception is only meant to extend to where they're covering their own assets, and that if I was moving my funds from Coinbase to Gemini, they would have to comply and collect that information. The US travel rule has similar results, but with different wording. As you can see here, it applies to funds that are, it does not apply to funds that are governed by the Electronic Funds Act. So that's to sort of avoid having to comply if you're using ATMs or point of sale devices, which would cover the goods and services. And it's a little more clear here where the transmitter and the recipient are the same person, and the transmitters and the recipient's financial institution are the same domestic bank. So in that situation, the US rule goes a little further and makes clear that if you're the same person making a transfer within, say, affiliated banking institutions, this rule wouldn't apply. But if it's from one bank to a different bank, but it's the same person, the rule would apply. And then I won't bore you with the details because you have the materials, but if the transmitter and the recipient are the same, then there are exceptions for certain named institutions. This slide shows different information that has to be retained. Obviously, under the travel rule in the United States, there is a list of information that the statute requires: name, account number, address of the transmitter, the date, the amount the transmitter is receiving, their identifier, and then the recipient information, the destination. FATF is a little bit broader, obviously, because it's a recommendation. They simply say name and account number, the originator's information with some specific data points, and then, of course, the beneficiary's name and their account number. I think that this exception that you see at the bottom on the FATF side is pretty important. If the information can be made available to the beneficiary financial institution through another means, then the ordering financial institution only needs to reference the destination account number as long as they need to trace it. And the reason for that is one of the primary purposes of these rules is traceability. And so they need some way to connect the full information that the sending institution is collecting with a link to the receiving organization, so that if traceability becomes an issue, you can trace it to that institution and then go gather the data from them. The record retention requirement is 5 years, and that's true for both institutions. And so that's an easy one. You know, you have to keep those records for 5 years, and in any given jurisdiction that could change, but at least between the United States and FATF, they have the same rule. Go to the next slide. Now, what happens if you're not compliant? If you're not compliant, the regulator can contact you and they'll ask for your records. And there are some results that could happen if you don't comply with this rule. In the United States, for example, you could lose your money service business registration. Your state money transmitter licenses may be at risk. There are fines. There could be an enforcement action. But most importantly, because this has become more public, I foresee a time when the travel rule and people's compliance with it becomes a source of reputational, a badge of honor, or a potential concern. And I'll just talk very briefly, and actually something came up today or yesterday that I would like to read that's not in the presentation. There was a speech given by Director Blanco on Friday to the Chainalysis Blockchain Symposium, where he said that on the topic of the funds travel rule, he said the following: I also want to take a minute to provide my thoughts on the funds travel rule. It applies to convertible virtual currency, and we expect you to comply, period. And by the way, the Financial Action Task Force, or FATF, as well, expects that jurisdictions will make sure it applies, as can be seen through their publication of their interpretive note to Recommendation 15, which urges countries to require money services businesses to handle convertible virtual currency to implement robust AML, CFT programs, including those related to record keeping. He went on to say, this idea is nothing new. Indeed, FinCEN, through our delegated examiners at the IRS, has been conducting examinations that include compliance with the funds travel rule since 2014. In fact, to date, it is the most commonly cited violation by the IRS against MSBs engaged in CBC money transmission. So at the end of the day, You know, I was going to talk for a bit, but I don't want to take any more time about some arguments that have been made that the funds travel rule really is supposed to apply to funds and not to virtual currency. I still believe that there is a qualified and good legal argument that the definition of funds was not intended to, nor does it by law apply to virtual currency. And this stems from a time when FinCEN distinguished funds as they apply to things like prepaid access to funds from convertible virtual currency. And they, in fact, invented the definition of convertible virtual currency because they did not believe they had authority without further legislation to govern virtual currency as funds. So how they get from there to applying the travel rule, which applies only to funds, and extending it to convertible virtual currency is to me, as sort of an academic lawyer, a mystery. But as that quote I just read you makes clear, from a practical perspective, if you're a financial institution like an MSB or a state governed or licensed money transmitter, and you are transferring virtual currency between yourself and another regulated institution, I think the practical result is you need to comply with this rule until any legal challenges are successful. Justin gave me 10 minutes. I've taken 12, so I'm going to pause and move on.
No, this has been great. We have one question that has come through, which is time frame. When is compliance supposed to happen? When are people expected to be in compliance?
So the travel rule here in the United States is already in place. And as that quote suggested, they've been assuming people should be complying with it since forever. So since 1996. So in the United States, you're on the hook and have been for a while. I will say that there's enough ambiguity about its application to virtual currency that I think that if you got into a tangle with someone at the IRS or FinCEN, you've got a good basis to probably be treated pretty leanly. But FATF's recommendations are by their wording intended to take effect and be effective in June of 2020.
Okay, great. Okay, this is I think really helpful, Joe. And we're going to come back to you and have you jump in here at any point, you know, as we talk to some of the other folks. I'm gonna switch now though and invite Tiana to talk for a little bit. So Tiana, we've heard all this information about what's happening with the travel rule. The big question is, what's the impact on the cryptocurrency and blockchain world? What's happening as of now as a result that the travel rule is starting to be enforced and implemented?
I think the thing that most of us can see pretty clearly is how many coins have been delisted, and that might be affecting price and liquidity. So I think that's a big issue, is our ecosystem being shrunk a little bit. I'm worried about when I read through the recommendations around what a VASPA was. It was pretty broad. They said that anyone that is engaging in or provide virtual asset activities, operations, products, or services could be considered a VASPA, and that would include nearly anybody that's working off of a public blockchain, because it's utilizing cryptocurrency in some form of that transaction. So I think that we need to be thoughtful about what this looks like, and that's why I wanted to join this conversation.
Okay, well, I think we ought to touch on a little bit more detail. So that, especially when you talk about coins being delisted, a lot of them, what we're seeing is privacy coins. Is that correct?
Yeah. So Zcash and Dash have both made some adjustments so that they could get relisted in some places where they could have the transaction data available. But how does that work with like non-custodial wallets? Where like one of the things that they're looking to have in the recommendation 70 and 71 and 78 that when I read through it, they want to be able to freeze assets or temporarily freeze them. And so then that kind of pushes into like decentralized exchanges and other peer-to-peer transactions where I don't know that there is a way that they could do that without fundamentally changing the way blockchains work.
Wow. So it does have the potential to have big impact within the ecosystem.
I think so. I really think it does. I think this is probably one of the bigger existential crises that our industry has had to face.
Yeah, and that's interesting because it appears that, I mean, there are people talking about solutions in which essentially what they're doing is requiring people to, the VASPs to kind of register within a group amongst themselves, and then by doing so, they can then exchange with one another. And that seems to create part of the problem that you're talking about. If we have a system where VASPs can only transact with VASPs, then what happens to, as you said, the privacy coins and also the non-custodial wallets?
Yeah, I would agree with that one. And it kind of starts to cut at the fundamentals of what cryptocurrencies and specifically private coins are trying to accomplish, which would be privacy, and privacy isn't a crime.
Yeah, and it would put a lot of those things in jeopardy. Is it, from your standpoint? Are you seeing a lot of big concern around this, or is there a lot of talk about either exchanges or other members of the ecosystem deciding that they do not want to participate, or that they are going to resist this? What's your sense?
My general sense is there hasn't been enough. Like I've been surprised at how little coverage of this there has been. That people haven't been more engaged with this topic, and I don't know if it's just because these rules come across so broad sweeping that it seems overwhelming and we're just all ignoring it. Or maybe they think that they can go to a non-complying country, which when I looked at the blacklisted countries, like who's actually on the list, it's only Iran and North Korea. Like, I know they say there's only 39 countries, but when you look at all the countries that that participate in this in some way, the only two that don't are those two. So yeah, this is a really big deal, and I just don't think people are taking it as seriously as it is.
So what do you think? Where do you think this is going? I mean, if you had to, look into your crystal ball and say what do you think is going to happen within the ecosystem? And any guesses? I mean, anything big impacts that you see coming?
How about this? I'll tell you what I'd like to see happen. I'd like to see our community come together and decide the rules that we would like to implement, and do some self-regulation, so we get to decide these rules and we don't end up having things come down on us that we just can't comply with, like the ability to freeze transactions between wallets and things like that. Like it would be helpful if we had a seat at the table, and I think the only way that we can demand having a seat at the table is to come together. So that's what I'd like to see happen.
Do you get a sense that people are doing that? I mean, from where you sit, are you seeing people starting to join together to address these issues?
Well, that's what I hope this this conference call is about.
Of course, this is part of it. Yes, absolutely.
Step one.
Yeah. No, I think we're seeing some activities certainly with Chamber of Digital Commerce and some other places where people are having serious discussions, and I think it's heartening, because I think, as you said, people are recognizing that you don't want to have something imposed on you. We'd rather proactively develop a set of solutions that we can all live with.
Yeah, I think one of them should be, what actually qualifies somebody as a VASPA, where it's not these really broad terms that seem like they could be applied to anybody, even if they're just like with my past company Factum, they're just securing data feeds on the blockchain. Does that also count as a VASPA? So being able to decide what that looks like so that we don't have sort of these draconian measures taken that could cripple our innovation in our industry.
Do you have a sense of what you'd like to see as the definition of a VASP?
I want to push that one to Joe. I feel like I should not answer that question.
Okay, fair enough. Fair enough. Does anybody else want to weigh in on that question of what a VASP should be and how it should be defined? We can move ahead. We can move ahead. Okay, great. What else? What else should we know? Anything else that you'd like to weigh in on as it relates to the travel rule and these issues?
I think that those were sort of the major ones that were sticking out for me. Were how does this affect privacy coins? How does this affect non-custodial wallets? How does this affect people that are just trying to trade Bitcoin between peers? Does that make them a money service business? So those were the things I wanted us to talk about. Good.
All right. Well, I'm going to jump over then, and we'll talk a little bit with Colleen now, if we can. Colleen, so your organization, why don't you just give us a very top line for those people who aren't familiar with CMT Digital, just a little sense of what you guys do, and then we can talk a little bit about what the relationship is with Travel Rule for your organization.
Great. Yeah. So CMT Digital is a subsidiary of the CMT Group, which is a 22-year-old proprietary trading and investments firm. So we've traded in the traditional equities and commodities markets in the United States, South America, Europe, and Asia. We set up CMT Digital, gosh, about 6 years at this point, because we really wanted to focus on the crypto space, this new asset class. It was very interesting to us from a trading standpoint, but also a little bit scary to us in the sense that we had always traded in regulated products and regulated markets. And of course, Bitcoin in 2013 didn't look anything like that. So what we do today, though, we've got the trading desk. So we trade in crypto spot and derivatives exchanges globally. We've also got a venture investing team where we've invested in 22 companies in the crypto blockchain space, and those are all investments in equity and operating companies. And then we also do quite a bit of legal policy engagement.
Great, great. So now from your standpoint, what's the impact on CMT? What's happening in your organization as it relates to travel?
Yeah, and this kind of goes into what Tiana was explaining. This definition of a VASP is incredibly broad. So the way we trade now, we do have an over-the-counter crypto trading desk, and we operate that desk within the confines of a 2014 letter issued by FinCEN, which basically distinguishes between users of digital assets and exchangers of digital assets. So because we're trading on a proprietary basis for our own account, we have felt comfortable that, we're operating within the parameters set forth in that letter. Now, the FATF recommendations, however, and with this broad definition, arguably, we could potentially be swallowed up by that and turn into a VASP. Our view, though, is that we don't think that FATF intended, we're operating under the assumption that FATF intended the scope of the recommendations to be consistent with FinCEN's prior guidance, that there is a difference between exchangers and users, but it's not clear. So, for us, it kind of remains to be seen. And to make it even trickier, we operate globally. And, FATF makes these recommendations, and then it's up to the individual jurisdictions to implement them and interpret them. So we could end up with a set of rules here under FinCEN, and then different rules in Korea and Japan and many other jurisdictions in which we trade. So for us, there's a lot that still needs to be sorted out. And then of course on the investing side, we have investments in a number of different crypto exchanges. So we're kind of monitoring what's going to happen there and how they're going to implement these recommendations. Well, and to Joe's point, I mean, arguably, this should have been in place since 1996. Although I also agree with Joe's point that, there is probably merit in at least the industry coming together and trying to have FinCEN go through the process of explaining, how they have the legal standing, to have the travel rule apply in our space. And I think practically we're going to end up in the same place, but I think forcing the regulator to go through that process is just good form and good practice and what we should be doing.
That makes sense. That makes sense. Yeah, I want to just touch on this point about the fact that, if you're operating in that many countries, every country could have a slightly different interpretation of the FATF, rules. And so, one country might require an address and an account number and the amount, and another country might want some additional information or not the same information. And that's got to be a challenge for any business who's operating globally.
Yeah, I mean, so here are some of the things that we've been thinking about to the extent they're helpful. One issue is, as you just said, we may have certain rules here in the United States, but an exchange that we're trading on overseas may have implemented these recommendations in a different manner, or they may be slow to implementing them. So all of a sudden, the VASP that we're trading through here has to give our personal information to some exchange in some other jurisdiction. And we're not really sure how they're going to protect that information, if they've implemented these recommendations different, what the security standards are around that. I mean, it just really changes the game.
Yeah.
So there's that piece. And then we also, and I guess this is really a question for Joe, but we really don't see any clarity with respect to multi-sig non-custodial wallets. So, could different jurisdictions say like a second signer is somehow a VASP? And then how does that work? So that wasn't clear to us. And then, we started thinking ahead, it's our expectation that at some point, your gaming tokens, which are going to be non-fungible tokens, but we expect that they will be transferable and exchangeable for fiat in secondary markets. And we expect that you may want to hold, like, for example, your Fortnite John Wick, skin that's now a token at a custodian, like Backed, right? And let's say that Joe has, like, some digital representation of Dwayne Johnson, The Rock. And Joe and I, want to exchange these tokens because, I like The Rock and he likes John Wick. And because we're both custodying those non-fungible tokens at VASPs, is this drafted so broadly that that transaction, just Joe and I transferring digital representations of our skins, is potentially covered here because there is a secondary market for those NFTs. I mean, that certainly wouldn't seem to be what, FATF was going for. But to Tiana's point, when you have definitions this broad, there I think are some unintended consequences here.
Yeah, I mean, if you look at the guidance, it would lead you to believe that, a skin that could be traded, that has value and could be traded and had, enough value to qualify would in fact fall under the travel rule. So, there is a lot to be figured out as things roll along. I mean, I know my son would be very upset if any of his skins had to be tracked by the travel rule. So
Totally.
So this is Joe. I've got just one thought on that, and that is, the exception that applies to transfers related to the transfer or exchange of goods and services. Maybe what you get to do is you say, great, if you're going to be in the broad brush category of strokes here, let's apply that across the board, both to the application of the rule and to the exceptions. And one way I might creatively try to argue that your NFTs, to the extent that they really are treated as a digital good rather than a digital representation of value, I think there is a good amount of room to argue that things like NFTs and and other assets that are not used for sort of the payment purposes might shoehorn into that exception. It's not perfect, and Colleen, you're exactly right to push on that button. So I'm not actually quarreling with you, but I'm just suggesting that maybe that's an area that one could push for an exception or a clarity of exception that's already built into the rule.
Yeah.
Very important. One more thing that you and I had talked about previously, Colleen, that I thought would be at least a point worth mentioning, is that the transition in the presidency of FATF is moving from the U.S. to China. Do you expect there to have implications related to the travel rule, or do you have any thoughts on whether it might?
Yeah. I was just over in Singapore, and it certainly does not sound like China will have a different stance in this regard, heading up FATF. Our hope would be that that FATF will carry out its objectives under China's leadership in the same way it has under other presidencies. So our expectation here is that the digital asset guidance will be implemented and elaborated on during China's presidency. And our hope, though, would be that FATF would look to play sort of a coordinating role. So differences in interpretation across member countries would be minimized. We would also ideally like to see FATF under the Chinese presidency, to some of Tiana's points, hopefully revisit and invite, revisit some of this and invite industry participation in. Now, the likelihood of that happening under China's presidency versus a different country, I'll leave that to other people to debate. But I think generally, we do expect China to pretty much, plow forward with this.
Okay. Great. That was really, really helpful. I'm going to now move on to Justin. Before I do, though, I did want to ask. We have some questions in the queue, and we are definitely going to answer one that has been asked already. But we also invite you. Now would be the time to try and get them in, because once Justin's section's over is when we're going to jump into questions. So with that, let me jump to Justin, and let's talk a little bit about what the Netki solution is, or what you're thinking about. I guess the big question is, what do people need to look for if they're coming up with a solution? How are they going to handle this? What are the kind of guiding principles that you think make sense for solutions?
Yeah, totally. I'm happy to jump into that and look at it a little bit. And so, with this travel rule piece, this is something, I know that for many people it's come up on their radar relatively recently, since the guidance came out a little bit earlier this year. In our case, we actually started investigating this back a number of years ago. All the way back, it was I think it was like May of 2015. It might have been March of 2015. Ripple entered into a consent decree with FinCEN. And one of the issues that came up at the time, and that Ripple admitted that they were in violation of and that they needed to fix in the future, was around travel rule. And in their case, they ended up coming up with a manual fix that would work in their kind of limited use case that they had there. But from our side, what we saw was really that this was sort of like a shot across the bow for the industry, and that really the regulators could be showing up around this issue at any time. And so what we wanted to do was try and get out a little bit ahead of the problem, so that we weren't rushing to a solution, and that we could make sure that we really sort of thought through what some of the requirements were, both from the regulator side, but as or more importantly, what were the important things that we needed to do or follow to ensure that we were supporting the growth and maturation of the Bitcoin or the blockchain or cryptocurrency ecosystem more broadly. So as we went to take a look at this, there were a handful of things that really came to mind for us. The first around this was that it was designed in a way much like the blockchain networks themselves are, to be entirely peer-to-peer. We wanted to ensure that there was no centralized APIs or centralized lookup services or anything else that you needed to go to that could end up as either a point of attack of load issues of scalability or a point of censorship inside of the network itself. We wanted to ensure that the solution that we designed was universally compatible. It was something that would work with any kind of coin, whether it's a coin that's native to the blockchain or whether it's a token that rides on top of the blockchain. And we also wanted to make sure, and we thought it was incredibly important, that the solution work not just with regulated entities, but that it also worked equally well with unregulated services like non-custodial wallets or like dApps. And the reason that that was important, is a combination of things, but really it's important that the regulated and unregulated sides of the ecosystem can continue to talk to and interact with each other. And we're already starting to see regulations where if identity information cannot be safely, privately, and confidentially and reliably exchanged between, say, a regulated service and an unregulated wallet, that those two ecosystems will start to split in half. So as I think Joe and Colleen touched on earlier, FATF came up with a bunch of high-level guidance around how this rule should work. And it was sort of a set of minimum standards. And some countries have decided to interpret those standards in different ways. And so, Joe talked about during his presentation that the FATF travel rule applies from FATF's perspective when both ends are a regulated service. But FINMA, which is the regulator in Switzerland, actually came out with their own rules that they said, look, we see what FATF did, but we feel like we need to have a tighter set of controls than that. And so they said, not only does this apply for every transaction from a dollar perspective, we don't care if it's $1, 1,000, or 1,000,000, but it also applies if only one end is a regulated entity and the other end might be an unregulated wallet, a dApp, or something else. Similarly, while it's travel rule today, we believe it's going to be sanctions in the future. And sanctions also applies when the other end is not an unregulated wallet. So from us, we thought it was important to support both regulated services and unregulated wallets. We thought it was important the solution be based on open source and open standards. And more important than that, that it be set up in a way that it's not an open standard that's controlled by any one company or any one service. It's actually a reason, someone pointed out in one of the questions that our service is based around a standard called BIP 75, which was a Bitcoin standard that we helped to author and helped to maintain some of the standards around. And we put it through the Bitcoin and the BIP process because we thought it was important for it not to be like a controlled open source thing, but to be something that actually went through a process of formal industry and community feedback and response. Like I said, rather than a process that might be more tightly controlled, or even worse, a process or a system that provided an advantage to any one company or another. Versus being set up in a way to invite competition in the ecosystem. We thought that it needed to be flexible. As we talked about, the rules are different in all these jurisdictions, and the protocol itself needs to be able to change to support that. And then, of course, it needed to be fast and easy to implement, and it needed to do what we could to protect privacy of users and the fungibility of the underlying tokens left on the blockchain. So a lot of things to think about other than just the law.
Yeah, it's more than just that, but I think understanding both perspective of the legal side as well as the perspective of the the blockchain and cryptocurrency ecosystem, this is a very extensive list. So the Netki solution seems to have fulfilled that in your sense, in your standpoint.
I do think so. And I mean, here we can actually walk through. I think we've got a quick video just on how it works, don't we?
Yeah. So let's play it.
with regulators like FATF, FinCEN, FINMA, and others increasing scrutiny of the cryptocurrency ecosystem, Netki's Transact ID offers a way for VASP to comply with travel rule, sanctions, and other requirements. It's a simple yet powerful solution that works with both custodial and non-custodial wallets that VASPs can implement quickly and cost-effectively. Here's how Transact ID works for a hypothetical transaction. Bob and Alice want to transact on a blockchain. In the same way Alice currently shares her wallet address, she sends Bob a URL for a private, secure, encrypted connection out of band. Rather than entering Alice's wallet address in the send field, Bob simply copies and pastes the URL Alice shared. Bob's VASP, VASP-B, opens a private, secure, encrypted connection to VASP-A, Alice's VASP. VASP-A signs the opening of the connection with its own identity certificate. VASP-B examines the certificate to determine if VASP-A is a party they wish to share their and Bob's PII with. For GDPR purposes, VASP-B can optionally share VASP-A's identity data with Bob and allow Bob to choose if he is willing to share his data with VASP-A. If Bob and VASP-B accept VASP-A's certificate, they proceed with the transaction. VASP-B shares its own, as well as Bob's, validated identity information with VASP-A. VASP-A can then perform multiple checks such as OFAC to determine if the transaction is okay to proceed. If compliance fails, VASP-A refuses the transaction and it is canceled. If VASP-A needs more data about VASP-B, they can request it. VASP-A asks Alice to validate that Bob is the person with whom she is transacting. Having validated Bob and VASP-B's ID, VASP-A then shares Alice's validated identity along with an address for Bob to send funds to. VASP-B can now run sanctions or any other checks on Alice's ID. After VASP-B validates Alice's ID, Bob signs a transaction to the blockchain that looks exactly like every other address-to-address transaction. In this way, no personally identifying information is ever written to the blockchain. VASP-B sends VASP-A a signed payment slip that includes all transaction details using the secure connection. VASP-A watches the blockchain for the relevant transaction and sends VASP-B a signed receipt with all transaction details once the transaction has been confirmed on-chain. Even better, all of this happens behind the scenes in the time it takes to open an email. If you wish to learn more about Netki's Transact ID, please visit us at www.netki.com.
Okay, there, information. But I think that last point was probably one of the most important, Justin. that happens. All the stuff that you saw in that video happens pretty much in about a matter of seconds.
Less than seconds, actually. I was. It was funny. I was. We've been showing this video and talking to people about this for a number of months now, and one of the exchanges that wants to be a part of our early release program around this over the next couple of weeks, I showed them a demo of this actually, working end to end on a phone and a server-side implementation. And when I walked them through it, they were like, wait, when did all this actually happen that you were talking about? Because from their perspective, it looked like we pushed a button in the app, and in the time it took to advance to the next screen, all of these steps had actually occurred behind the scenes.
It's similar to when a page loads on a website, right? All that stuff is happening back behind the scenes, and most people don't even recognize that there is information going back and forth.
Yeah, exactly that. And so, what we wanted to do was design and build something that was very, very robust and featureful in terms of the kinds of things that you were able to do with it. And then, on top of it, make it very both familiar to users. Their user experience is almost exactly the same as how they send and receive cryptocurrency today, but also very transparent in terms of, or very fluid in terms of the way that it fits into the user experience, and how from a user's perspective, it doesn't really appear that there was any change at all, other that they may have a little bit richer data around their transaction than they used to have.
Great. Okay, so did you want to touch on anything else here, or I think we've covered it pretty well? Do you want to? I think it's important though to talk a little bit about just the status of the solution and how the Transact ID has been already seen by a number of different governments.
No worries. Yeah, I'm happy to go through this. So as I said, we've been working on this stuff since back in 2015, and we released the standard around it in early 2016. And we actually took our first customer live on the platform back in 2016 as well, which was a global bank using it on an internal private network. In the time since then, back in 2017, MAS, the regulator over in Singapore, commissioned a study on how do you build a compliant Bitcoin ecosystem. And our tools, our onboarding tools, as well as BIP 75, the standard that we use for our Transact ID solution, were recommended as the way to build in that compliance. Similarly, this solution's been reviewed as part of the central bank digital currency system for BIP, one of our partners down in the Caribbean, as well as we've had it reviewed with Department of Treasury, FinCEN, et cetera, and actually OzTrack as part of a project review we did back in 2016 and 17 as well. So, this has been an area where we've been working with both regulators, Big Four accounting firms, financial institutions, and companies operating in the crypto space for 3, almost 4 years now.
Okay, great. So I'm going to, did you want to cover anything else on Transact ID? Because there are a couple of questions. We're at that point. We want to try and keep to our 1 hour timing.
Yeah, why don't we shoot to the questions?
Okay, so one of the questions that came up was basically, what does it take to implement this solution for an exchange, for example?
Sure. So, implementation around this can be relatively straightforward. So the protocol itself is open source. So, the semi-brutal way to do it would be to go read the standards document and implement it from scratch, which you could certainly do. That said, next week, the week after, we're going to be releasing a bunch of open source libraries that will run on your Android phone, on your iOS phone, inside of your server architecture with Java and Python libraries, et cetera, that actually handle a lot of the implementation of the protocol for you, including verifying and validating information at various steps and things like that, so that from a developer's perspective, they'll just be making some local function calls to local libraries rather than having to implement the whole protocol itself end to end. So the implementation should be pretty straightforward. It can get done in a day, a couple of days. Really, the bigger part of the implementation is going to be thinking through what you want to do from a data management and data flow perspective. So Colleen had talked about earlier, there's going to be use cases where, for example, your customer is wanting to do a transaction with an MSB that may be in a jurisdiction that doesn't have great privacy laws. And, you're going to have to make a determination around how do you decide how you want to handle that transaction. Do you, for example, just share the identity data and have the transaction go through transparently? Do you ask your customer whether or not they're cool with sharing the data there? Do you make the decision for them that you're not comfortable sending their identity data to certain places, and so therefore you break the transaction? Those kinds of decisions are going to be, frankly, more time consuming than like a technical implementation or setup.
Okay, so they have to do a lot of thinking about the business rules and also anything that might relate to user experience. Those are going to be the big things that they have to think about.
Exactly that, and compliance pieces as well, right?
Okay.
So one of the things that comes up as a part of this is that in many cases, you're going to want to run an OFAC or a sanctions check on your customer's counterparty on the remote end. Well, different companies may have different risk tolerances around the types of checks that they want to run on a customer counterparty versus a customer, for example.
Okay, good. We have another question, and it relates, this is for the panel at large here. A question about the difference between storing information versus just being able to access it from the blockchain. So if transactions are and the transaction data is available on the blockchain, then do they really need to have some sort of repository, or isn't that something that they could access from the blockchain? And I'm curious about what the difference is in the minds of the regulators.
So I'll take this one, and then I think some other people may want to jump in as well. So some data is definitely on the blockchain. So for example, like if I'm looking at the Bitcoin blockchain, I can see the sending address, the receiving addresses, the change address, the amounts, things like that. And so, it is possible that you could use the Bitcoin ledger for those portions of the data if you had a way to, tie that transaction in with the rest of the metadata and the other things you needed. You would never, ever, 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 ever want to send identity data on the blockchain itself, because a blockchain is designed for all participants to see all data. And so you could do some funny things around encryption that would hide the data for a little while until the encryption failed. But eventually all that data that you were trying to obscure would become public for everybody to see. And so the identity data and data like that, you would never want to share on chain. You would always want to share it via a private protocol like the one that we designed.
That makes sense. Does anyone else from the panel want to chime in on anything related to that question?
That was a perfect answer.
Yeah, I agree, Justin.
Okay, great. There is now, Justin, you may have touched on this question, that it was one of our questions was asked, is that as one of the proposed solutions is using BIP 75 based on BIP 70, will the plan to disable BIP 70 as a default in Bitcoin Core 0.19 may be a problem? BIP 70 is seen as a security and privacy issue and is not widely adopted. So that was the question. Did you want to respond to that one?
Sure. So de-implementing BIP 70 in the core won't have any impact on what we're doing at all. So, BIP 75 was designed to be a completely blockchain agnostic solution. So while we went through the Bitcoin standards process, it's not a Bitcoin only standard, and implements across any public or private blockchain. And it's also designed end-to-end to be a wallet-to-wallet protocol, and not to be a protocol that's built in, for example, at the core transaction layer, but rather for all of the exchanges of data to happen privately, peer-to-peer between the wallets itself. So, I think that actually, if you go back, many of the folks who are actually utilizing BIP 70 today, such as BitPay and others, support taking BIP 70 out of Bitcoin Core, because it's frankly not the place that it belongs. It belongs to be implemented at the application layer, and not at the protocol layer in the core.
Great. So at this point, I don't see any additional questions coming. Is there anything else that any of the panelists like to say? Because we're almost out of time here. But if there's any closing remarks anyone would like to make? Okay. Well, I did want to provide some information. I wanted to thank the entire panel for taking the time today to provide this information on travel rule, because it's been very, very, very useful. There's information here on how to contact the members of our panel. They are all, as you can tell from the conversations that we've had, extremely knowledgeable, and all would be glad to talk more at length, I'm sure, with any of you. They are authorities in this world, so this is how to reach out to them. We do have one last question that came in, which is, what are the penalties for or the risks if you don't comply?
I can take that.
Great, Joe.
It's jurisdictionally specific, and just to remind everyone the way this works, FATF they're not a government, they're not a regulating body. They produce recommendations, and those are aimed at harmonizing whatever individual jurisdictions adopt. So by way of explanation, the US travel rule is an adoption of a rule that was patterned after FATF's recommendations, but it was adopted by it was adopted by and sits under the Bank Secrecy Act in the United States. It is an implementing rule that is overseen by both the US Treasury through FinCEN and the IRS. And so the penalties are whatever penalties are either assigned specifically to violation of that rule under the US Code, which don't exist in this case. There's no specific penalty to violating the travel rule, but the violations that could occur, or so the penalties that could occur would be penalties associated with violating anything under the Bank Secrecy Act. And those include fines, potential criminal action, and obviously injunctive relief, where you may get a cease and desist order or an order to comply or have other escalating action. So if it's a different country, it could be whatever law they tuck it into, that law would be the hammer, so to speak, and whatever penalties are available under that law would be the ones you'd be subjected to if violating the rule in that country.
Good. Well, it looks like when we did our poll, it said that basically almost a little over 80% of people were either just getting started or evaluating solutions right now as it relates to travel rule, as opposed to being well along the path. So I think it's important. One of the messages to take away is that people need to get moving, because the time is of the essence, and the travel rule is coming whether or not people like it. So with that, I want to say thank you to all of our panelists. An excellent discussion today. We will have this recording available and up for people to watch, so please feel free to share it with others. If you enjoyed it, we hope you did, and we look forward to our next webinar and our next time visiting with everyone. Take care.
Thanks, Tom.
Thanks, Tom.
Thank you.